want to mention that there would be one more speaker coming to the class. He is from Tower Capital. He was also a student of mine and he was a graduate of Stanford. So not sure when exactly he's going to come. So as you know that there are already two speakers coming. One from Blackthorn Investments, the other one is from JP Morgan Chase, and we'll have this new speaker from Tower Capital coming. Okay. And also I think there was an inquiry from one of the students asking for what exactly is the assignment schedule and when the project is due, sort of thing. I think I mentioned that in the syllabus I've clearly stated when the proposal is due, project proposal is due, and also when the project report is due. And as far as assignments are concerned, there are going to be 3 assignments. I would like to pace them in such a way that the last assignment is due the week before the last week of classes, so that you will have 1 week for the last week to spend your time on projects that you're supposed to do. Okay, so I'll post the exact schedule a little later because it's not clear in my own mind how much I'm going to cover in a week and so on, so it'll take some time, but I'll try to post it either today or tomorrow. Okay, and I also want to mention today I have to rush out after the class. I have a off-campus meeting, so I need to go, but I'll be here tomorrow after my class in my office, room 204. I think if you have any questions, drop by. Okay, I think we talked about these volatility models before, and I want to make one comment here. There is a study done by Rob Engel and his colleagues recently, and it's an interesting piece of work. I would like you to take a look at it. It sort of talks about practical guide to forecasting volatility. Okay, and if you Google it, I think you should be able to find this. This is by Brownlees, Engel and Kelly. And mainly I think they looked at a number of volatility models, and the main concern was that there was a big market shakeup in 2008. Do the volatility models predict the kind of downfall? So they fit various kinds of models here. They consider specifically about 5 models, and the basic model is Garch 1-1 model. But they mentioned that there is a model by Gloston and others which seems to do very well. I want to briefly mention that so that you can see why it does better. Okay, so if you look at your notes, you'll see that the basic model we have here is that return is equal to, and mention that as sigma t times epsilon t. Okay. So we talked about 2 assumptions on epsilon t. Epsilon t follows normal distribution with mean 0, variance sigma squared, and we also said that we could entertain the possibility of it follows t distribution too. T distribution. Okay. So if you remember the basic Garch 1-1 model, which we covered last class, is given as follows. It's given as sigma t squared is equal to some, I'm going to write this, I don't remember what the notation I used. I think let me write it as alpha 0 plus alpha times RT squared plus beta times sigma t minus 1 square. So that is the model we used, Garch 1-1 model. Okay. So this is the very basic model they consider, And the alternative model is given by this quantity here. And I want you to see why this does better. Okay. So this model is known as T-Garch, which is threshold Garch model, D-Garch model. And essentially the model states as follows. It's given as sigma t squared is equal to, and the first part of it is the same, alpha 0, plus the second part of it, there is a change, you get alpha plus gamma times. So there is an indicator function, RT is less than C, times, this is gamma, I think I just want to, and then RT squared, RT minus 1, should be RT minus 1 squared, sorry, RT minus 1 squared plus beta times sigma t minus 1 squared. Okay. So this is a model proposed by Glaston et al. 1993 paper. Okay. And they consider various other models like exponential Garch and so on. So they consider E-Garch, and they also have asymptotic power arch and so on. So let's not worry about those things. I think the main point of this, going through this is to ask you why this model does better than any of the other models here. Okay. What exactly is this model here? You can see this is supposed to be 1 when the return is less than some quantity here, right? That's the indicator function. Okay. Then gamma is supposed to be positive. What exactly we mean by this? What is the implication of the term? Implication of the term is that when the returns are negative, we are saying the volatility is going to be higher. Okay. When the market goes down, volatility is higher. Remember, we talked about it before. So that is explicitly modeled into this equation. This model seems to do better than any of the other models here. Okay. Essentially what we need is to fit this model keeping track of when the return reaches a certain limit. Okay. So usually they take C to be 0. Whenever it is negative, it's given a different weight, and that's how you calculate this information. Okay. So this is one model that I think, an alternative model that you can think about. Okay. So there is also one other model I think want to briefly mention here is a stochastic volatility model, and this is supposed to be an alternative to Arch and Garch models. Okay. So the idea is fairly simple. Okay. So let me write here stochastic volatility model. Okay. So here the same setup that we have, RT is sigma t epsilon t. Okay. And now we are going to model the variance as some sort of AR process, alpha 1b, etc. up to alpha m, b to the power m, sigma t squared. I think they tend to use log sigma t squared, t squared. This is equal to alpha 0 plus some error term here. Okay. So this is the stochastic volatility model. Okay. What is the difference between this model and the Garch model we have? The difference I think is that you're modeling the log variance directly as a function of its own past. There is no RT squared coming into play, but eventually you have to use RT squared to do this calculation. The main problem with this stochastic volatility model is that you can see that there are two types of error terms here. There is one error term here and another error term here. The only sequence that you observe is RT, and you have to know these two error terms. So there is no way you can get unique answer because you have only one side is RT, the other side as function of two error terms epsilon t and nu t. Okay? So here one has to use some sort of Monte Carlo simulation methods, MC methods. MC methods are nothing but you fix one, you vary the other, you fix the other one, vary the other, then you find the best combination of the two. Okay? And so I think two errors here, two innovations. Epsilon t and nu t, but only one RT that we have. So need to use some sort of MC methods. MC methods. Okay. So generally I think they found that the stochastic volatility model fits reasonably well to the data, but their out of sample forecast is somewhat suspect. It's still not that good. Okay. So these are all competitors to the models. So based on my intuition, I think if you want to use it in practice, probably this model by Gloston, probably the best model that you can have. Okay. So that's all I wanted to say about the Arch and Garch models. And let's talk about the high frequency data. I think I have quite a few things I want to cover here. And before I move on, I think this model has been tried because your ultimate goal is to model the returns, right? Where the returns are going. Okay. So this model here, you can see you're going to assume that RT follows some ARMA PQ and the innovations follow some Garch HQ, and then you can combine the two equations. But based on our experience, we know that once you have the returns, they don't have too much structure to it. ARMA PQ, P and Q are going to be almost zero. There's nothing much left there. Okay. And similarly, I think innovations, you don't have to go beyond Garch 1, and and this is a way to combine the two. Even after combination, I think the forecasting RT is not all that easy to do. Okay, there is still not much information coming from variance that adds much value. Okay, maybe in short durations they may have some information, but in the long duration doesn't carry much information. Okay. By the way, I think I want to mention, based on that study, assuming that these errors follow student t distribution doesn't seem to make too much difference. Okay. Going with normal distribution itself is good enough when it comes to forecasting volatility. That's the main conclusion of that study. Okay. So based on all these things, I would suggest that try to model the average using some short-term moving average models, and then model the variance using this sort of threshold Garch models. So that combination probably would yield better results than any of the other things that I mentioned here. Okay. Okay. I think there are a few other things here that I want to mention, but I'll come back and comment on this a little later. But let me talk about the high frequency data. And So this is the data set I'm going to use as an example here. And just briefly, I think, I want to mention what I have here. So that is the data that's given here. So you can see this is for Microsoft, just month of January, okay. And as many of you know, the size of this data can be pretty large because we are keeping track of every transaction that takes place. So here I'm giving only the market trades, okay. I'm not giving the information on quotes, the buy side quotes and sell side quotes. I'm not giving. If I include that, it becomes fairly huge file, okay. Once you have that file, you can actually construct order book information, because at any point in time, how many orders are there on the buy side, how many orders are on the sell side. You should be able to construct that, okay. I have a program that does it in R, but it's very complicated program. You really have to go through all the cancellations that have taken place, and for all the executions, you have to account for all that information, okay. Here what I have is that you have the timestamp and you have the price. You also have the unit size that have been sold or bought, and then the last column gives you the exchange, okay. So I think I have this sort of covers about 7 or 8 exchanges, okay. I have a list of names for these exchanges too, okay. And couple of things I want you to keep in mind. You can see that how do you compute the duration between successive transactions? What is the usefulness of that information? The duration is supposed to tell you, if there is any information that's flowing in about the stock, trading is going to be more intense, right? So successive duration is supposed to give you information about how the information flow occurs, okay. But having said that, I also want to caution you, with the algorithmic trading, now we know that large orders tend to be sliced into small pieces and they are sent to the market on a frequent basis. If that is the case, how much information the duration carries is still not clear, okay. But let me go through this. You can see a couple of ways the durations are computed. Here I'm just going to take the duration between two successive observations as duration, and sometimes people take that only if there is a price change, that's when the duration is taken. Can you see that for the first 4 observations the price remains the same, 26.99, and then the price changes here. So only this difference between these two seems to be taken as a duration that corresponds to the price changes. So a couple of ways you can do this, okay. And you will also see that there's lots of transactions of not during the hours that the market is open. So what I did here was to discard those observations and then focus mainly on the observation that take place between 9:30 and 4. Between 9:30 and 9:35, we'll see lots of observations get stacked up there, mainly because these are orders pending. They get processed as soon as the market opens. So in order to not to create any bias, I removed some of those things, okay. So given that, what exactly is the usefulness of this information? What kind of models you can expect, okay. So let me go here. Okay. So we are going to talk about the duration models. I'll also mention lots of open issues here, okay. So you have to use this high frequency data to study market microstructure issues. Should say market micros, not macros. Market microstructure issues. Microstructure is that how trading occurs. That's how people buy and sell. Understanding the process is a microstructure issue, okay. It also gives you information about liquidity and volatility estimation, okay. How do you measure liquidity? what exactly we mean by liquidity. Anyone? Yeah.
Time it takes to sell an asset.
Time takes, I think, are you getting the money you want at the time you want? Okay, that's a liquidity measure. Okay, and estimating what the market liquidity is has become even more complicated with so many exchanges that are being operated, right? In some exchanges there is this taker fee, and some exchanges they have a maker fee, and people are funneling their orders wherever they are, they get favorable price. Okay, if that is the case, we have to measure the liquidity based on not only the flow of orders but also where the orders get executed. Okay, and it's very important because understanding high frequency data is you can develop some trading models. Okay, so trading models will cover in detail little later. The main idea in trading models is that where do you send your order, whether you want to send the order as a market order or a limit order. These are the questions that you need to decide, and you need to decide fairly on a instant basis. Okay, so one of the key quantities we look at is what we call as order imbalance. Order imbalance is nothing but imbalance between supply side and demand side. Okay, so there are key papers that I want to mention here. The classic papers are by Hasbrook and Easley and O'Hara, and Engel and Russell paper is the one that sort of formalized these things. Now at least we can quantify the certain aspects of high frequency data. Okay, so we have seen this diagram before. So from 9:30 to 4 there are several transactions that takes place. The T's are called tick timestamps, and Y's are called marks. Marks are price, volume, also mean that whatever else is going on in the market. Okay, and studying this, the tick timestamps and the associated variables, sometimes known as mark point process. Okay, and so there are lots of issues here. There is the prices are not necessarily synchronized. Okay, and this used to be a case before discrete prices. Now we have 1 cent price, so it doesn't apply here. There's a multiple transactions within a second. Okay, what do you do with that? Okay, this is mainly due to latency issues. People submit orders. When it gets executed, whatever the recording time, that's what goes into it. So there is always multiple transaction. What I do normally is that I just aggregate them, and unless there is a special reason to believe that those multiple transactions come for a certain reason, but I couldn't figure that out. There is also intraday periodicity, which I think will show. The periodicity is that lots of transactions happen in the morning and the evening. There is a period of period when nothing much is happening. Okay, so usually I think there is an intraday pattern that you can see. Similarly, volatility is higher during the morning time and the evening time, and it is less during the in between. Okay, so given this sort of setup here, I think the key questions are the following. When will the next event occur, right? When will the next trade occur? That's an important question to ask. Although it looks like a simple question, it's very difficult to answer in practice. And the second part of it is, what will be the value of a mark? Just saying that what will be the value of the price, and what would be the volume that gets transacted. These are the questions that we want to think about. Okay, and if you start aggregating this information in small time intervals, obviously there is going to be loss of information. And when you say information, what exactly we mean by information? We are going to talk a little bit about estimating volatility, right? Estimating the true variance of the stock price. And if the market friction is just going to add noise to estimating the variance, how good it is. You can as well aggregate the data and get rid of the friction. Okay. So we are going to talk a little bit about what exactly we can do in order to make sure that the estimate of variance that we have is the true estimate of the variance. Not, it doesn't include the market friction. Okay. So some of these things we talked about, fixed intervals. Okay. So if you make it too wide, I think you're going to lump all the variations. If you make it too narrow, you're not really reducing the data. Okay. And it's possible that when you put them into small intervals, some intervals may not have enough information, so you cannot do interpolation. That will introduce spurious correlations. And you can't come up with one single numbers to say that every stock has to be aggregated to 5-minute or 2-minute or 1-minute interval. Different stocks have different frequency and intensity. And I think generally, for daily returns, there is lag 1 cross correlation between stock returns and lag 1 serial correlation in a portfolio return are observed. Okay. When we say cross correlation, essentially what it means is that you are looking at the correlation between two stocks. Usually one goes up, the other one comes down. Okay. That's a kind of cross correlation we generally see. Okay. Okay. So I think the discreteness part, I think you can forget. This was before 1/8 of a dollar. Now we have the decimalization. So most changes are within a dime. Okay, and it sort of induces high degree of kurtosis. Okay, so this is a pattern that I was mentioning here. You can see that based on empirical analysis, they have shown that volatility, you can see standard deviation of mid-quote price change. What is mid-quote price change? It's supposed to be the best bid plus best ask divided by 2 is the mid-quote, right? How it changes is you can track this to see how the price has changed. Okay, so if you look at the standard deviation of the mid-quote price change, you can see generally it's large in the morning, larger in the afternoon, larger when the market closes, somewhat smaller down. Okay, and durations the opposite. You can see short durations in the morning, short durations in the evening, and then you can see that okay. So time between trades shorter near open and close, and generally it's longer in the middle. Okay. How is this diagram useful? How do you use this information? Anyone? How do you use this information? Yeah.
See if there's a change in a pattern.
You can look at change in pattern, but if you are a trader who wants to send your order next day, right? How does this diagram help you? Yeah.
You will get a better price in the morning and the evening. Because
I think the volatility can cut both ways, right? You take a better chance. But in terms of trading, I think you can see more trading occurs in the morning and in the evening. And if you want to send your order, and if you want to be anonymous, you may want to send during the time when there are more trades. That's how you can use this information. Okay. Also, I want to mention that there is a whole topic called quantitative posting. The idea is to decide what volume is likely to be traded at various intervals next day, and decide how you want to send your orders. Okay. And there is a clear periodic pattern you will see, and using that periodic pattern you can decide how much you want to be part of that particular time interval. Okay. Okay. So high frequency data display some dependence. Okay. and the dependence is due to bid-ask bounds. So many reasons. It could be due to price discreteness, bid-ask bound, and execution of orders. Okay, and there is one simple model that's used in practice, and it's almost a classical model. So I thought I should briefly mention this. This is by Richard Roll. Sometimes it comes in various forms. I think the original model is by I have actually 3 different versions of that model, so I'm just going to try to see how I could. Okay. I'm going to use this part here. Yeah. So let's assume that this is the best ask and this is the best bid, PFB. So one has to cross the spread to execute. Execute. Okay. So the effective cost is supposed to be taken to be PFE minus PFA plus PFB over 2, which is the midcoat. Okay. So I'm going to say that MT is the quote midpoint, just logged. It's very similar to the true price that we mentioned, okay, MT. So, and PT is the log trade price. Okay. Those of you, I think you want to compare your notes. This is like PT star that we used before. Okay. So the model we have is the following. Okay. Model is that I'm going to write it as role model. Says that MT is equal to MT minus 1, like PT star is equal to PT star minus 1 plus epsilon T. And this epsilon T, as I mentioned, you can just take it as normal 0 sigma squared. That is the true volatility of the stock. Okay. So what you observe is the following. PFT is equal to MT plus, remember last time we mentioned this as UT, which is the market friction. And I'm going to write it, market friction is nothing but friction that occurs to cross the market, right? I mean, that's a friction, okay? So I'm going to write it in the following form, MT plus C times, for better lack of term, I'm going to use QT, okay? So what is C? C is nothing but mid spread, which is P of A, P of B over 2. So that is the effective cost. Effective cost. Okay. Okay. And this is the next part of it is the key. QT is equal to 1 if it's a buy, minus 1 if it's a sell. Okay. So in practice, how do you know that the selling or the transaction occurs because of buyer initiated or seller initiated? How do you decide that? In that information is proprietary information. All the trading companies have that information. But if you go to the public data, that information is not available. Okay? How do you decide that it is the buyer initiated or seller initiated? Okay? So there is a important result that people use in practice, and now I think the investment agencies are able to give us this data on buyer initiated and seller initiated stuff. But if you are going to use the trade and quote data which is available publicly, that doesn't tell you who initiated this. Okay, just tells you the market trade. That's all. Okay, so one way to do this is that say mention this is the mid quote here, P of B over 2. Okay. So the idea that's been around that people use in practice is that if the price falls here, it's favorable to the person who is asking. So this could be taken as seller initiated. And if the actual price falls here, this could be taken as buyer initiated. Buyer initiated. Okay. So this particular type of rule is known as named after Lee and Reddy rule. Okay. Actually, Professor Lee teaches here at Stanford. Mark Reddy is Wisconsin. We have some. I know Mark very well. We tried to do some joint work once. So these are the kind of things that people use in practice. But let's see what exactly Rolle's critique leads to. Okay. So now we have this information here. So you can show that if you look at the price change, which is RT is equal to P of T minus P of T minus 1. So by going through these calculations, you can see this is going to be MT plus C QT minus MT minus 1 plus C QT minus 1. So this is C times delta QT plus UT. So that's what you have here. Okay. So C is okay. So you can show that covariance between RT and RT minus 1, because delta QT, as you know, is QT minus 1. So you can treat this as a binomial distribution and go through the calculations. For instance, if buying and selling occurs equally likely, you can show that the variance is given by the following quantities. Let me write here. Covariance between RT and RT minus 1 is given as minus, just going back and forth between the two, could be taken as minus C squared. Okay. Minus C squared. You can just do the quick calculations. You can show that that's how it works. Okay. QT is buy and sell. Let's assume that it follows binomial distribution with just 1/2 is the parameter, minus C squared. So what is the main point of this exercise is to show that when there is a bid-ask bounce, when people have to cross the market, cross the bid-ask spread in order to make the transaction, you would generally see that the returns are going to have some sort of negative autocovariance term. Okay. In fact, I think this is used sometimes to measure what the transaction cost is, what is the C's, what is the effective cost is. In fact, this is given as C is equal to square root of minus covariance between RT and RT minus 1. So this is known as the effective cost. Okay. So still it's being used in practice to estimate what is the transaction cost. Transaction cost is essentially crossing the bounds. Okay. So generally you would see that there is some dependence in the high frequency data, mainly because of this bid-ask bounce. There's various other reasons why they see, but here I think this is one way to quantify what the dependence is. Okay. So volatility clustering is similar to low frequency data. You'll see that, and the only thing is that under aggregation the dependence tends to decrease. What we mean by aggregation, if we take long enough duration and try to aggregate the data, the dependence gets lost. Okay. But at the high frequency level, you want to keep the dependence because it comes handy to figure out what the next period's variance is going to be. Okay. Before I forget, I think I had one other important point to mention about the volatility models. Remember I mentioned the paper by Brownlees and others. You should take a look at it. I think the models tend to work very well for 1 day ahead forecast. So if the volatility is high today, what the volatility going to be next day, the forecast seems to be doing very well. Okay. I think the question is that is 1 day good enough, right? You may want to know a little bit longer duration volatility forecast that may help. I think there's something when you read through that paper, just focus your attention on that too. Okay. 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 There are two approaches people have taken. There is a long history of looking at this kind of point process models, but in the context of financial time series, the first model was given by Engel and Russell. Okay. So essentially look at the duration between two successive observations. They introduce what they call autoregressive conditional duration model. It's very similar to Gorge models. Okay. What is the feature of Gorge and what is the feature of duration that looks common? Both are supposed to be positive numbers, right? Volatility is a positive number, duration is also a positive number. So for that, in that sense, I think it comes very handy. They also look at the stochastic intensity models. What is roughly the idea behind the stochastic intensity models? You look at a duration, say 5-minute duration, look at how many trades occur during that 5 minutes and see whether that intensity changes over time and model that intensity as a function of other factors that go into in the market. Okay, that roughly the idea behind it. So either you can look at the durations and model the durations, or you can try to aggregate the data on a small time units and look at the intensity of trading that takes place in those time units and model that intensity over time. Okay, so these are the two approaches that we take. So this is a very nice book by Cox and Lewis. I think it's very good to read, but I think I'll try to summarize the essential points as much as possible here. Okay. So when it comes to duration models, we need to have some baseline model that we can compare with. Okay, and the baseline model is always going to be exponential distribution model. Okay, how does it come? So if you look at the number of events that take place in a certain interval, it was most of the time it's modeled as a Poisson process. Okay, how many of you are familiar with Poisson distribution? Okay, what is the main property of the Poisson distribution? It's the average and the variance is supposed to be same for all the intervals, right? And so if the number of arrivals in a unit of time follows Poisson distribution, one can show that the time difference between the arrivals should follow exponential distribution. Okay, so if there is no dependence at all on these arrival rates, that would indicate that the time between arrivals should follow exponential, so which means that there is no information carried over. It's almost like assuming the observations are independent. Okay, so that is the baseline model we are going to use. Okay, so essentially what we are saying is x of I, which is the duration between two successive events, follows exponential lambda. So it's almost memoryless. I think it just tells you that there is nothing we can predict when the next event is going to occur. Okay? But if you look at the actual duration data, they do exhibit some serial dependence. They also exhibit some intraday seasonality. Okay? And durations are not independent exponential. There is an important concept that we are going to use. The hazard function is not monotonic. So we are going to model this via autoregressive point process models. Okay. Before I get to it, I want to briefly mention some simple properties of what exactly is the hazard function? So the concept of hazard function. Okay. So in order to define that, I'm going to write this S of x, sometimes known as survival function. Survival function is that if, what is the probability that somebody is going to survive beyond X units, and this by definition is less than or equal to X, should give you 1 minus f of x is the survival function. Okay. So the hazard function is h of x is equal to the density function of x divided by s of x. This is what we call it as hazard function. Okay. So one of the distributions that's used in practice here is this Weibull distribution. Okay. So the density of Weibull is given as f of x is equal to alpha over beta, and then x over beta alpha minus 1 exponential x over beta to power alpha. Okay. Because when alpha is 1, this is supposed to be exponential distribution. Exponential distribution. So that is the baseline distribution that we want to check. But I think, this is more general. So if you see patterns deviating from exponential, you can try to fit this Weibull distribution. Okay. For this particular distribution, you can show the following. So let me write here. Okay. You can show that the survival function s of x is given as exponential minus x over beta to the power alpha, and h of x is given as alpha over alpha times x to the power alpha minus 1. So you can see that when exponential distribution, we are supposed to have alpha is equal to 1. For exponential distribution, hazard function h of x is given as 1 over beta. Okay. So that is a constant hazard function. Okay. When alpha is greater than 1, h of x is increasing function, and alpha is less than 1, h of x is a decreasing function. Okay. So what we need to compute here is some sort of hazard function to see if you see a constant hazard function. Okay. So instead what I have done here is to compute some sort of cumulative hazard function. So the idea being that if you add these constants over time, you are supposed to see a straight line. Okay. So I'll explain in a minute what I did exactly, because this is based on earlier work on this kind of data. So we have this January 2013, it's a tick data as I mentioned. I'm going to look at only 9:30 to 4 p.m. I'm also not going to worry about different exchange information I had. I'm going to aggregate all the exchange information and create some sort of superbook and then use that superbook information. Okay. So when I plotted the data, this is what you see. So this is the empirical graph for aggregated data. You are supposed to see a straight line if it's an exponential distribution, and you can see that it's not a straight line, right? It's okay. So what exactly I've done here, I did the following. So let me show you. Okay. So I did two things here. One is that I took the durations. I took all the durations, okay, and for a month or so, for that particular day or so, I had so many of those durations. I ordered them from the lowest duration to highest duration, d of n 0. So I plot actually log of 1 minus I over n0 plus 1 versus d of y. Okay. You can show that if you have this is a empirical graph, you can show that if you follow exponential distribution, you're supposed to get a straight line, but it clearly shows that there is a pattern here that indicates that it's not an exponential distribution. Okay, I didn't try to fit any variable or any other distribution. I just wanted to get some handle on if the distribution is normal, if the distribution is exponential or not. Okay, this is the first thing I did. The second is that I'm going to show you the autocorrelation function of the durations of the di's. Here I don't have to order them because I need to keep the durations as it is. That's the only way I can figure out if the current duration depends on the past durations. So the next graph that you see clearly shows that there is autocorrelation in the data. Can you see that? Okay. So it's a fairly large set of observations. So the red line you see is fairly narrow, but you can, from here you can see that there is a fairly strong autocorrelation. Can you see that? Okay. So how do you use this information? Clearly shows that current duration depends upon the past duration, right? So you should be able to model that information. Okay. How is it modeled? I think so these are the models that we are going to see. You can model this as x of I is given by that quantity t of I minus ti minus 1, and you can model this as the exponential auto regressive conditional duration models here. But if you look at this model for psi of I, what kind of model is that? How does it look? Just by look, it's like ARMA or the Garch model, remember? Okay, it's exactly Garch model. Okay, so in fact I think I didn't try to fit these things for this particular data. So the idea I think is that Garch models, if you are as I mentioned, Garch models can be thought of as ARMA models. I think here ACD models also could be thought of as ARMA models. Okay, the only thing is that you have to make some assumptions on this epsilon I, mainly because x of I on the left hand side cannot be negative, right? It's always going to be positive. Slightly different from Garch model, because in the Garch model you had returns on the left hand side. So returns could be positive or negative. So there is a little bit of flexibility on the error term epsilon I. Here there is no such flexibility. It has to be positive. It has to follow some positively distributed variable. So we are going to assume that follows exponential. But in terms of properties, it's pretty similar to what we saw with the Garch models. Okay. So there are two other models we talked about. One is the Weibull model. There is also this generalized gamma distribution that's being recommended in Say's book, and I generally use Garch models with Weibull distribution that tend to perform reasonably well. So here is the data that been tested out. Okay, so one is the EACD model, exponential model, and the Weibull model, and then the exponential model with a little bit of extended parameters they have. So this is supposed to be data for IBM data for 5-day trading data. So they have durations exhibit some autocorrelation, and they go through the parameter estimation. But the key part of it is looking at this column of alpha 1 and beta 1. What exactly is happening here, alpha 1 and beta 1? If you add them up, what kind of numbers you get? Close to 1. Can you see that? Again, that indicates that one has to do some sort of successive differences of the duration and then model it. Okay? So this is based on a survey paper that I picked up. You can also check on the Jung box test. I think this is something that I have not explicitly mentioned. I hope all of you know what Jung box test is. Jung box test is nothing but testing for bunch of autocorrelations to be 0. Okay? It's sort of an omnibus test. So if the test is accepted, that means all of those. Here in this case, we are testing whether the first 10 autocorrelations are 0 or not. Okay? If the test is accepted, that means all 10 of them are 0. If it gets rejected, at least one of them is different from 0, then you should go back and check. Okay? It's a okay. So there is also some sort of extension. This is very similar to ARMA models for log durations, and so essentially have the log duration as a function of the past durations, and then you can model that as a variable. Okay. I think the main problem that's being mentioned here is that you're sort of separating the average duration and also the variance in the duration separately, and that separability may be an issue because whenever the mean gets higher, the variance also gets higher, so it could be an issue. Okay. So these are the various models people use in practice. Okay. I think the most useful value of some of these things could be how do you model the tick time and the marks. Okay. So the tick time data based on duration can tell us when the next transaction is going to occur, right? That's one of the reasons we want to use it. But we also want to know how the marks are going to change, how the price is going to change, how the volume going to change. Okay. So in order to do that, you look at model the change in price from I minus 1 transaction to ith transaction. Again, we are going to see that buyer initiated and seller initiated. Okay, this is assigned volume. So this sort of models the change in price and also volume as a function of the past volume and past changes. Okay, so you can use this vector autoregressive models to cover this kind of changes. We'll talk a little bit about vector autoregressive model a little later, but this is the main approach they use. Okay. Again, I must tell you that at the high frequency level, forecasting power of some of these models are still not that good. But I think whatever you can get hold of this, I think you should try to use it. Okay. Any question? Any question on this? Yeah.
What is the intuition behind that buyer initiated and seller initiated signed volumes? So are you saying that the volume can be negative or positive?
No. I think if the buyers are initiating this, that means that there is a demand for it, right? If sellers are initiating this, maybe there is not a good news about the stock. That's a distinction. Okay. As I mentioned before, I think if you are going to use public data, there is no distinction between these two. You have to infer them from the price, how close it is to, best bid and best ask. So this kind of data is available in the brokers have that information. We don't have that. Okay. Okay. I want to go back a little bit on from the last lecture. I think there is something here that I still have to cover here. So we talked about using time series models to model the return and the variance volatility, and we also talked about using ACD models and some sort of vector autoregressive models to model high frequency duration type of model. Okay, there is something in between what I call as medium frequency. Here I think we are going to talk about should be price bins. Price bins. Essentially what we do is that we compute the open, close, low and high. Okay, and it's sort of, instead of taking high duration data with high frequency, trying to look at every transaction, it sort of acts as intermediate between low frequency and the high frequency data. Okay, and most of the trading companies tend to use this price bins data quite heavily. Okay, what exactly is price bins? So if you want to look at, say, 5-minute bin, you take the observations that take place in that 5 minute and summarize that information in terms of 4 quantities: open, high, low and close. So those are the 4 numbers that go in. Okay, and I think most of the agencies that provide data tend to summarize the data in that fashion. It's very easy to use it. Okay, but of late I think there has been question about how do you measure volatility based on these bins. Okay, what is the measure of volatility? Okay, why is it important? Because your goal is to measure some sort of short-term volatility. Okay, so when you look at volatility, I think if you include the high frequency data, it's going to contain the variance of the friction, right? Variance of the friction just adds noise to the data. It doesn't really add any value to the data. Okay, just to motivate this, I want to write down a couple of things, and maybe we'll come back and pick up next time on this. Okay. Okay. Do we have enough time to do that? I think we're running out of time. When I start on this, we'll go for some time. Let me give you a few. These are all directly from Say's book, so there's nothing new here. So volatility estimates from bin data. Okay. So these are the estimates that mentioned here. You can get this sigma hat 0 t squared is given as closing price t minus 1 squared. So this could be used either for daily data, could be 1 hour bin, 5 minutes bin, you can use it. Okay. And the second estimate is sigma hat 1 squared, which is given as opening price minus the closing price previous day square divided by 2f plus CT minus OT square divided by 2 times 1 minus f. F is between 0 and 1. What exactly is F? F is the fraction of a day the market is open. Okay. So if it is 9:30 to 4, we know it's open for 6.5 hours, right? So a fraction would be 6.5 divided by 24. That's the estimate you should use. Okay. And the second one that I mentioned before is that look at high minus low square divided by 4 log 2. Maybe I should just 4 log 2. Okay. And the one I've used in practice quite successfully is the following, and they call it as this few estimates I'm leaving out here. This is the one I've used in the past, which is 0.5 times LT square minus 0.386 times CFT OT square. So these are the various measures that are used, and you can see that they try to use as much as the bin data as possible. Remember, we have only 4 quantities, right? Opening, closing, high and low. They try to use this information. Okay. And I must also tell you that many of these numbers, the optimal numbers that we get here, are based upon the daily frequency data. If you are going to use this for 5-minute bin, 10-minute bin, as I mentioned before, there is likely to be autocorrelation in the data, right? How that information gets taken into account to come up with the optimal coefficients here is still not clear. Okay, that's an area I think if someone wants to work on, they should try. Okay, the numbers that I have given here are probably valid for, low frequency daily data. But if you are going to bin it more coarsely, like 1 hour, 30 minutes, or 5 minutes, I'm not sure what should be the optimal combination one should look into. That optimal combination, keep in mind, should take into account short-term autocorrelations. Okay, something that you can think about. Okay, I'm going to stop here, and if you have any questions, send my way. Okay, and all of you have a happy holidays. See you.